Hello, money mavens and soon-to-be moguls. Are you psyched to conquer the world of passive income but breaking out in hives at the mere mention of taxes? Well, fear not. Today we're venturing into the tax jungle, machete in hand, ready to slice through the undergrowth and reveal 10 crucial tax hacks. Our mission? To turn this tax maze from a nightmare into a playground, ensuring that your hard-earned passive income stays right where it belongs, in your wallet. Don't let the tax boogeyman scare you away from your passive income dreams. Let's kick it off with a toast to transparency. Every penny you pocket, from dividends to Dogecoin, must be declared. In the world of finance, honesty is truly the best policy. You might be wondering why. Well, it's simple. When you're transparent about your earnings, you're playing by the rules of the game, and that's a game you're more likely to win. Think of your income as a collection of cash streams, each with its own source. These sources could be dividends from stocks you own, interest from your savings account, or rent from a property you lease out. Every single one of these sources contributes to your income, and they all need to be reported. It's like painting a financial picture of your year. Each source is a different color, and together they create a complete image of your financial health. So when tax season rolls around, remember to declare all your cash streams. Having an income to report is a financial win on your financial freedom journey. Not all income is taxed equally. Some investments might be taxed at a lower rate. This is where the beauty of varied tax rates comes into play. It's like a game of hide and seek, where you're the seeker, and the hidden treasure is the income that attracts a lower tax rate. Let's delve into the game. Picture your income as a colorful spectrum, with each color representing a different type of income. Now, every shade is taxed differently. Ordinary income like your salary or business income might be taxed at a higher rate, while qualified dividends and long-term capital gains often enjoy lower tax rates. It's like a buffet of tax rates, and you get to choose what you want on your plate. This is the game where patience pays off, literally. If you're investing for the long term, you could enjoy lower tax rates on your returns. It's the treasure hunt where everyone wins, especially if you're playing the long game with those investments. If your passive empire takes a hit, those losses might cushion your gains. Let's dive into the balancing act of passive activity losses. It's like a game of financial Tetris, where the blocks are your income and losses. The goal is to fit them together perfectly to maximize your score. In this case, your after-tax income. The Internal Revenue Service, or IRS, has specific rules about what constitutes a passive activity. Generally, a passive activity is one where you do not materially participate. This could be a rental property or a business in which you're not actively involved. Now here's the twist. If your passive activity generates a loss, the IRS allows you to deduct these losses, but only against passive income. This means you can't use passive losses to offset your active income, like wages or self-employment earnings. But if you've reported both passive income and losses, those losses can help soften the blow of your taxable passive income. Picture this tax hack as a financial Tetris game. You're aiming for that high score. Uncle Sam may also want a piece of that pie if you're actively involved in your passive income business. When you're generating income from a side hustle or a business you're actively participating in, that's self-employment income. And guess what? Self-employment income is subject to self-employment tax. This tax is a combination of Social Security and Medicare taxes that you, as a self-employed individual, need to pay. However, it's not all doom and gloom. There are ways to mitigate the self-employment tax. One method is to structure your business as an S corporation, which could potentially help you save on self-employment taxes. But remember, every situation is unique, and it's always best to consult with a tax professional before making any decisions. Another lovely tax tidbit is the difference between active participation and material participation. If you do not materially participate in the business, your income may be considered truly passive, and therefore escape the self-employment tax. Sometimes your income can truly be passive, escaping the self-employment tax if you do not materially participate in the passive income business. Let's chat about that sweet depreciation on rental properties, a cozy little tax nest. Depreciation, in a nutshell, is the reduction in the value of an asset over time due to wear and tear. In the case of rental properties, the IRS allows owners to claim yearly depreciation deductions, which can significantly lower taxable income. Think of it as a yearly gift from Uncle Sam, acknowledging that your property won't stay brand new forever. It's a tax benefit exclusive to real estate investors, and it's a big one. Now here's the catch. When you sell, your tax bill may be higher because of something called depreciation recapture. Essentially, Uncle Sam wants back some of that gift. So while depreciation deductions can be a great tool for reducing your current tax bill, always keep in mind the potential future tax implications. It's a bit of a balancing act. Stay sharp about this rule to keep more earnings in your pocket. The 1031 exchange is a real estate chess move. It's a game of strategy that allows you to say, "Not today, taxes," as you roll your profits from one investment into another. You see, real estate investors often use this method to defer capital gains tax. That's the tax you'd normally pay when you sell a property at a profit. But here's the catch. It's not as simple as selling one property and buying another whenever you feel like it. There are strict rules to follow to qualify for this tax deferral. Firstly, the properties involved must be like-kind, which in tax terms means they must be of the same nature or character. Secondly, you have a limited time to identify and close on the new property. So learn these rules, play the game right, and you could potentially dodge the tax start by rolling your gains into a new venture. It's like tax evasion, but legal. Some bonds are like financial superheroes. They're resistant to taxes. Picture these as your personal financial bodyguards, always on duty, keeping your hard-earned money safe from the taxman's clutches. Now, how do these tax-exempt bonds work, you may ask? Well, when you invest in tax-exempt bonds, such as municipal bonds, the interest income you earn is generally not subject to federal income tax. This can be a game changer, especially for those in high tax brackets. But what's more, in some cases, this income may also be exempt from state and local taxes, depending on where you reside and where the bond is issued. So, while these bonds may not always offer the highest yields compared to taxable bonds, the tax benefits can make them a more profitable choice, especially for investors in higher tax brackets. Therefore, investing in tax-exempt bonds can be like having an invisible shield against taxes. It's like suiting up in your financial Iron Man armor, ready to take on the world. For the globetrotters raking in international income, beware the double taxation dragon. If you're flexing your financial muscles on the global stage, earning passive income from foreign investments, there's a sneaky beast you need to be aware of. It's called double taxation, and it's exactly what it sounds like, paying taxes twice on the same income. Here's how it works. Let's say you're a US citizen, and you've got a rental property in, let's say, sunny Spain. The income you earn from that property might be subject to taxation in Spain. But wait, there's more. Because you're a US citizen, your worldwide income is also subject to US taxation. That's right, Uncle Sam wants a piece of your paella pie. But fear not, intrepid investor, for there are weapons in your arsenal to slay the double taxation dragon. The United States has tax treaties with many countries to prevent double taxation. These treaties allow for foreign tax credits and exclusions that can offset the taxes you owe in the US. Also, there's something called the foreign tax credit. This can allow you to subtract the taxes you paid in Spain from your US tax bill. There are some rules and limitations, of course, but it's a valuable tool in the fight against double taxation. Beware the double taxation dragon. It can mean double the taxes without the right strategy. But with knowledge and planning, you can keep more of your hard-earned global gains. So there you have it. 10 tax hacks to keep in mind as you navigate the tax jungle of passive income. We've journeyed through the importance of income reporting, the variety of tax rates, the balancing act of passive activity loss, self-employment taxes, depreciation benefits, the strategic 1031 exchange, tax-exempt bonds, and the tricky territory of foreign income tax. These are all key elements to consider when dealing with passive income. Each has its own set of rules, nuances, and opportunities for you to maximize your earnings and minimize your tax liabilities. Remember, understanding the tax implications is as crucial as generating the income itself. It's not about merely making money. It's about keeping it and growing it. So get out there, conquer the tax jungle, and let your passive income flourish. Remember, it's not just about stacking that paper, it's about making sure it sticks around too. Did you find these tax hacks helpful? If so, make sure you hit that like button. It helps us know that we're delivering the content you need. And if you think your friends or colleagues could benefit from these tips, don't hesitate to share this video with them. The world of taxes can be a complex one, and the more people we can help navigate it, the better. If you're not already subscribed, do it now. We regularly share financial wisdom and other valuable insights to help you make the most of your money. Thanks for watching, and remember, knowledge is power when it comes to taxes. So stay informed, stay ahead, and conquer the tax jungle. Until next time, happy tax planning.